Yeah, they announced that the panel has to begin, so which we already...
Dear forum participants, we kindly ask you to proceed to the forum halls. Sessions are to begin now.
Okay, then let's continue to save time, because I know we are under some sort of time pressure. And here I would like to introduce you some of the speakers. Of course, in the previous panel you already had a chance to, and you know very well those who are at the panel. These days we have Nouriel Roubini, who will probably speak first, as he has to leave a bit earlier. Then we have Professor Edmund Phelps, who is Nobel Prize winner in 2006. He has a distinguished academic career working at Columbia, Yale, Pennsylvania University. Nassim Taleb, whom you know from last year and his publications, and he will be our third speaker with the opening statement. And I think we'll proceed with an open statement of about 5 minutes, and then we'll continue with the discussion. Michael Power, Investec, he's a chief investment strategist, and he has extensive career, also experience in currencies. And we have Marc Faber, the Gloom, Doom and Boom report editor and publisher, whom you also know very well. Martin Gilman, he is also a very extensive career at the International Monetary Fund. He was also IMF representative in Moscow in the 90s. Currently professor of economics at the Higher School of Economics, which is a state university here. And Michael Wexler, Maple Leaf Company, and also very extensive career and experience in currency trading, risks, etc. And we have to find out during our session, I doubt if we can come to a consensus here, but nonetheless, we know that in the past year we have seen quite significant volatility on the forex market. Those who remember our last year's session on the currencies, some people expected the collapse of the dollar. Some people were talking about euro as a potential substitute for the dollar. There have been also a discussion within the government circle, G20, Russia and China at some point proposed to establish a sort of artificial currency based probably on special drawing rights of IMF. And those discussions are now somehow suppressed. We haven't seen much developments in this issue. At the same time, the dollar most recently strengthened. Today was another day of dollar strengthening against the euro in particular, despite the fact that it was announced that today the Congress in the United States should discuss a new revision, a ceiling for debt, American debt is supposed to be raised to $14.3 trillion US dollars as opposed to 12.4 trillion, which was the December 25 decision last year. Despite widening U.S. debt, the U.S. dollar remains quite popular currency. And what are the trends in the global economy we already discussed last year? What's going to happen on the currency market, long-term and short-term? That's a subject for today's discussion. And I would like to proceed with Professor Roubini with his initial statement on this issue.
Well, can be said about currencies, and I'd like to concentrate my remarks on the US dollar, both in the short run and the question of whether the US dollar could be replaced eventually as a major global reserve currency and over which time frame. First observation I'll make is that if I had to look at the next 2 or 3 years, I would say the dollar is to weaken further on a trade-weighted basis for a number of reasons. The US current account deficit is still very large, even if it's been shrinking, and some of the shrinkage was cyclical rather than structural. US policy is going to remain easy in terms of monetary policy for the foreseeable future. and I see an anemic recovery of growth in the United States. So all these factors imply another 15 to 20% trade with the weakness of the dollar over the medium term. Now, in the very short term, like the first half of this year, some of these dollar-funded carry trades may be reversing for two sets of factors. One is that there is going to be, for a couple of quarters, better economic news out of the United States. Those, in my view, are temporary factors like restocking, fiscal monetary stimulus, base effects. But the second half, the economic weakness is going to reappear again. And secondly, right now the dollar is also strengthening mostly because the euro is weakening, because of concerns about Greece, sovereign debt in the Eurozone, and you name it. But on a trend basis, the dollar has to weaken. Now, the question is, where should we weaken against? And my view of it is that the dollar has already weakened a lot relative to the advanced economies currency, like the euro and the yen, meaning the euro cannot go to 150, 160, and the yen cannot go from 90 to 80 relative to the dollar, because if that were to happen, that will kill any economic recovery in Germany, Japan, and the Eurozone, where the only source of growth has been net external demand rather than domestic demand. So that will cause a double dip in Japan and the Eurozone. So market dynamics can push the dollar to that kind of weakness against euro and yen, but if that were to occur, then that kills any growth in Europe and Japan, and then those currencies weaken again. It's clear that the weakening of the dollar on a trade-weighted basis should occur over time against the currencies that are still undervalued, the Chinese currency, and I would say a basket of Asian currency. And I would say probably even some of the further of the commodity currencies. As long as commodity prices are going to remain high, then that strengthens their currency. The trouble, however, of that part of the adjustment is that a year ago the Chinese decided to repeg to the US dollar and follow the dollar downwards with the weakness of the dollar. And because of that, all the other Asian emerging markets, but increasingly also other emerging markets in the world, do not want to essentially let their currency appreciate, even if these currencies are undervalued. And they've been very aggressively intervening to prevent that appreciation from occurring, because they worry about losing market share to a superpower export-wise like China. So the rate of currency intervention in emerging markets now has accelerated to an annualized rate of about $1 trillion in the second half of last year. And as long as China stays on hold, in my view, China first is going to stay on hold. Secondly, at some point, they're going to move, but they're going to move very little. Then the incentive for other emerging markets to let their currency appreciate is going to be limited. The only thing that might incentivize them to move a little bit more is going to be concerns about the rising inflation if the growth overheats. So they're going to move, but not as much as otherwise. So in some sense, the dollar has to weaken, but the adjustment of the dollar is blocked by the fact that relative to advanced economies, the dollar cannot weaken further. And relative to the emerging markets against which it should be weakened, the behavior of China prevents an adjustment generalized of EM currencies against the US dollar. So we live in this paradoxical world today in which the US wants a weaker dollar, the Eurozone needs a weaker euro to grow its exports, Japan needs a weaker yen to grow its exports, China wants to keep its currency weak to grow its exports, and every country in the world wants a weak currency. And by definition, not all currencies can be weak against each other. If everybody attempts to weaken their currency by monetary easing, then eventually you might have a debasement of fiat currencies against real assets. That's a story that eventually this attempt to devalue your currency by everybody to excessive easy money might lead eventually to inflation. Not in the short term in advanced economies, because there is a slack in goods and labor markets, but eventually the solution might be inflation, in which case oil, energy, commodity, gold prices could sharply increase. So that's one set of considerations. The second set of considerations I'll make is about the long term. There's a lot of restlessness about the US dollar, about the US budget deficits and the ability of the US to essentially do a fiscal adjustment. And eventually that might mean that the path of least resistance is to monetize this fiscal deficit that will lead to inflation. Now, the problem is that, one, the US is doing it, but it's likely that other advanced economies are going to decide also to run fiscal deficits that are unsustainable and monetize them. So where does it leave other currencies? Secondly, while there is kind of unhappiness with the US dollar, everybody has accumulated too much dollar reserves. China has 2.5 trillion, Japan, Russia, Brazil, Gulf states, you name it. Emerging markets now have over $4 trillion of dollar reserves. The question is, what could be an alternative to the US dollar if the dollar were to essentially disappear as a kind of major reserve currency? And when you look at the alternative, The situation is much more unclear. The euro doesn't look like a likely candidate because right now there are concerns about breakup of the monetary union. We don't even know if there's going to be euro in a few years if Greece, Italy, Spain, Portugal don't get their act together. So the euro doesn't look like a likely candidate. The yen cannot be because Japan is in terminal decline, stagnation, and the Japanese never wanted to internationalize the yen. The British pound and the French francs are too small to make a difference. People talk about the SDR, but the SDR is a unit of account. There is no agreement to make it the more important part of the global economy. You know, the Chinese made a proposal, but it's highly unrealistic that's going to be the case. You know, people talk about gold, but gold is never going to be, again, a major reserve currency. Yes, if everybody tries to cause high inflation, eventually, you know, gold prices are going to go higher, and oil prices, commodity prices are going to go higher, but the stock of gold that is out there is so small that gold cannot become really a reserve currency. In the best of scenarios of high inflation, gold prices go through the roof, and people diversify, but that's not makes it as a major reserve currency for the long term. And therefore, the point is there is not a real alternative to the US dollar. So we are stuck in a situation in which there is concern about the US fiscal and current account deficit. There is concern about the willingness of the United States to do adjustment. People would like to diversify away from dollar assets, but there is no clear alternative to the US dollar. Now, finally, the RMB eventually could become a major reserve currency, but that again is going to take 10 to 20 years. To be a major reserve currency, first of all, you need to have a more flexible exchange rate. It's something that China is not doing. You need to have a liberalization of the capital account, something that China so far has not done. You have to liberalize your domestic capital markets. You have to create a deep and liquid market for your own domestically currency-denominated bonds. Eventually, those things could happen, maybe in 10 or 20 years, but for the time being, that's not the case. So people are unhappy about the dollar. They're uneasy about the dollar. The trouble is there is not yet a long-term alternative to the US dollar.
Thank you, Nouriel. And our next speaker is Professor Phelps. And as far as I know, he was going to talk about long-term, say, 10-year horizon, and mostly about the US dollar in his initial statement. And here I have some clarifying question. As Professor Roubini mentioned, there is no alternative to US dollar so far. But at the same time, we have fiscal deficit around 10% of GDP for second consecutive year in the United States, which means that raising rates by the Federal Reserve is going to be a quite difficult decision, if at all. On the other hand, U.S. also has current account deficit. To finance this deficit, you need to raise rates. So a sort of mutually excluding actions are required. What's the way out of this situation?
I think I'll make my initial statement first,
Okay.
since it's initial, and then try to cope with that exciting question later on. Let me note by way of preface that there are two conceptions of a country's real exchange rate. One is the number of baskets of non-tradables overseas needed to buy a basket of the country's non-tradables. The focus is on non-tradables because in this view, tradables always exchange one for one across national borders, measured in the same currency. So it's easier to go with that point of view, although most of what I say doesn't depend upon it. I could express everything in terms of a different world. As I see it, the post-crisis countries, the U.S. and the U.K., and the epicenter countries such as Spain and Ireland and Iceland and Germany and some Eastern European countries, will suffer depressed levels of business investment for all or most of the decade. I think there are two underlying forces behind that. First, innovativeness in the U.S. economy, I won't speak to the U.K., has slowed down over the past 8 to 10